Good afternoon, everybody, and welcome to Essentials. It's lovely to be hosting you here again. And this is a particular subject that's very close to my heart. I think we all remember the glory days of the JSE, and I remember days where there were over 600 counters. Clearly, that's shrunk dramatically over the last decade. And rather than making it easier, I think it's made it a lot more complicated, where you have to be a lot more pragmatic and a lot more selective in making money out of an SA equity portfolio. I'm going to host you on today's journey. Before I begin, just a couple of quick ones. Just to let everybody know, the BCI SA Equity Fund is now available on the Glacier and Momentum LISPs. Anchor also has available on the PPS LISP on a restricted basis. That's the Worldwide Flex Income Fund, BCI Equity Fund, and Global Equity Feeder Fund. Because it is restricted on PPS, if you do want to use it, please speak to your PPS consultant, or alternatively, just get hold of me directly and we will add you. Our team for today, no stranger to Essentials, is Peter Armitage, who's CEO and co-CIO of Anchor. Peter needs no introduction and has been feels like he's been in the JSE since it opened. And Mike Gresty joins us as head of SA Equity, and they'll be taking us on this fascinating journey over building an SA equity portfolio. Please, if you could type your questions into the chat function, and Mike and Peter will try to get to as many of them as they can at the end. So without further ado, I'll hand over to you, Pete.
Right, guys, we're going to do this on kind of a bit of a conversational basis. Mike and myself will be talking through. I think South Africa is a very different investment universe to the rest of the world. And what we aim to achieve today in hopefully about 30 minutes is to talk through, what we face in managing SA equity portfolios and go through those basics. I think just for those of you who are not familiar with Anchor, just 2 or 3 bullet points. We started, I think we'll have our 10th anniversary early on into next year. We're an investment-led business with about 30 investment professionals. We manage about 5.4 billion or over 90 billion rand of assets. And we've got a team that is delighted to service you. What we're covering today is the composition of the JSE and its challenges, the way we approach markets, which is kind of a growth at a reasonable price type equation, examples of how we build a position in the sector, what to look at when you look at JSE local counters, and realistic thoughts and theories to take into account when creating a portfolio. We're certainly not trying to market SA equities in this presentation. We're talking about managing an SA equity portfolio. I think what will come through is, how much easier it is in the global space to follow an investment philosophy and find interesting opportunities. But at the same time, we conclude, especially when we get to the end and look at bottom-up opportunities, we still think there's lots of very interesting opportunities in the SA market, and shares certainly don't find their way into our portfolio without an expectation of a 15% plus return over a 12-month period. Maybe, just to hand it over to Mike, just to run us through running a SA portfolio versus a global portfolio.
Great, Pete. Thanks very much. So, just looking at this slide, there are a couple of points that, we will run through, but there are a number of other ones I want to allude to as well. And, Pete made the point earlier on that, certainly the SA market does present some real challenges relative to what you see elsewhere in the world. And, Dale alluded to the point about how much the universe has shrunk. So, the reality is if you sort of think about your extremely wide array of choices internationally, when you focus right down into South Africa, what we see, and it's certainly been a particular challenge over the last 6 or 7 years, is the dearth of growth. That's the first thing that we note, and really that's been a theme that's played out very strongly globally. And if one thinks about how, in particular, the US market has performed relative to South Africa, a big component of that outperformance has been driven by those big tech growth stocks, where we are very frankly limited in that respect. In fact, really, we only have, as we highlight there, Naspers as our single play from a growth perspective. Other things that we see is that the JSE is not a particularly good reflection of the South African economy. You can see that.
Be a good thing.
I was just going to say, Pete, it depends on your perspective. That might be a good thing. And, this peculiarity that largely because of, let's say, the mining exposure as well as NASPers, you could say we're a pretty big play on China to a large degree. Again, you could look at that as good or bad. I think another point to note is that where you seek to play global themes that you may be attracted to at certain points in the cycle. And then when you try and look at it in a South African context, because of the fairly limited array of options, it often boils down to very much a single stock discussion. And a few examples of that would be, again, NASPers, or if we were to talk brewing, for example, it would be AB InBev. And I think a particular challenge there is that, you may very well get the thematic call right, but because of company-specific issues, and again, I'm thinking of NASPers at the moment, which is obviously suffering a real challenge with what's going on in terms of its Chinese exposure, you can get the investment performance wrong. And that's an added, I would say, difficulty in terms of trying to play global themes through the options we have in South Africa. Back to you.
Yeah, so I mean, I think just as a starting point, just, I said at the beginning, we're not trying to market SA equities, and I think one needs to be realistic. Global equities have given you an 8 to 10% per annum return in US dollars over the last kind of 10 or 20 years. It's in fact been better than that. I think you've been close to 12% over the last 5 years. I think our global equity fund's done about 18% a year for 5 years, with probably more predictability. It's a bigger universe, and there's less country-specific stuff. And globally, you're looking at GDP growth of about 4% per annum. When you come back to SA, we think that the local equity market can return 5 to 10% per annum over a time period, but the risks are higher. And then you've also got the currency, which is, I think, a frustration for everybody. It's stronger than it was 5 or 6 years ago. I think a lot of people have exposed themselves to the expectation of a weaker currency. So what this boils down to, and I think one of the themes that we're going to kick through with is, we're looking at indexes and macro picture. When you actually drill down into shares, what we'll show you is, in fact, only about 20% of our SA equity fund is sensitive to the SA economy. And one can flex it as you move along. There's quite a few kind of specific shares which have got their own stories in it, and we'll run through a few of those. Mark, over to you. So how do we look at, I guess this isn't just SA stock selection, but from a philosophy point of view, maybe to explain how we look at the market.
Yeah, I think that's a good point, Pete. It's not like we apply a very different approach in how we think, strategically about building an equity portfolio. And what we've learned and has served us very well offshore is a model that we apply in South Africa. But, it's more than just sort of blindly applying consistency across the business. It has a very good business reason for why we do this. And when we start with kind of how do we see the SA picture at a high level, we're working from a perspective that we are not looking through rose-tinted glasses at the outlook for South Africa from here. We are concerned about the lack of commitment so far to structural reform, weak economic growth. And while we hope that we're wrong on these things and we are surprised to the upside, our basic premise is that tide is not going to lift all boats. We're not going to be bailed out by this. And essentially that keeps us honest. And certainly I think in many other markets, when things are going well and you've got a strong tailwind at your back, the odd investment mistake here and there that you can get away with, you're simply not going to be afforded that luxury in South Africa. So, our core philosophy is built around identifying quality businesses. As you see there, I think Pete mentioned at the outset, our style we define as pragmatic growth at a reasonable price. We are not value managers. We're happy to pay up within reason for quality businesses. And because of our view that this is likely to be a challenging market going forward, this is not only about trying to find good growth compounders, but there's also a defensive aspect to that, in that we see these type of businesses as providing us with a decent, what we call an operational margin of safety. And what I mean by that is if you consider these quality businesses with strong balance sheets, good high returns on capital, decent margins, in downturns, they're going to suffer along with everybody else. But the likelihood is that they'll survive. where, weak businesses with low margins, weak competitive moats, when things get tough, the likelihood is that those disappear. And it's those kind of risks that we're trying to avoid in a market that, frankly, as we say above, is not going to lift all boats. Some of these other points on the slide are probably allied to high return on capital. We're looking for quality rand hedges. In South Africa, there are many of what I would call dirty rand hedges, businesses which have gone offshore, buying poor quality operations, only to be exposed in tougher times. So there we've listed a couple of what we would regard as genuine quality, globally competitive rand hedges. We could probably add Richemont to the list, but we've got Bidcorp and Naspers there. To be honest, if only we could find a diversified portfolio of companies that tick our box in terms of high quality, high return on capital, compounders that grow. The reality is there just aren't enough of those. And as a result, what we look to do is augment our portfolio of, if I can call it, core holdings, with what we would sum in aggregate as special opportunities. And those may come from a range of different sources. It could be, MTN there I've mentioned, which I would see more as a business turnaround. New management coming in, starting to talk the right language about capital discipline, exiting non-core operations, simplifying the business. Grindrod, another example of a value extraction, simplification, exit of non-core businesses. And then Investec, probably another example there of, new management coming in, getting rid of sacred cows, and cleaning up the business. And then, again, a group that we tend to look at are businesses that are actually investing for the future. And sadly, there are not a lot of them when you go through the JSE. Many of them are in sort of stay in business CapEx mode. But the reality is that will only take you so far. And I've listed a couple of businesses that are certainly present in our portfolios, would be the likes of a Discovery or again a Naspers, which are actually investing properly for the longer term. Probably allied to the high return on invested capital motto is we're looking for businesses that are, quite cash generative, strong balance sheets. But when I say strong balance sheets, I'm not talking about lazy balance sheets. It's businesses where they're active. Your management teams are not sitting in the C-suite just occupying the seat. They're doing things. They're changing things. Markets do change, and they're actually deploying their balance sheet. And then finally, I wouldn't say that on this last point, necessarily we're always in these sort of areas all the time, but we're open to the fact that, cycles do change. These are not necessarily businesses that we would want to hold as core positions through all of time. At the moment, for example, we're seeing a cyclical rebound in construction. We recently been through a long run in commodities. And if those, cycles are played correctly, obviously a source of great returns. And on that point, I just wanted to highlight this point on compounders versus cyclicals. As we mentioned earlier on, the South African market is certainly very much more cyclically orientated than you would expect to see offshore. And as I'm sure many of you know, the sort of materials and mining space has been very much front and center in terms of performance if you look back pretty much since 2016. So if you've got this one right, the likes of Anglo American, the platinum shares have done extremely well. But what I wanted to highlight on this slide is to give people a longer term perspective. If you step back, and what we've done here is rebased a selection of companies that we would class as your high return compounders. They're not necessarily the best examples of this. I could have used Capitec, which is probably a well-known example of a company that has absolutely shot the lights out. But these are very solid examples too, and just overlaid those with how some of the resources counters have done. The Anglos has obviously been a very strong performer since 2016. Implats has also been a great example of that big upside we've seen in the platinum sector generally. However, just cast your eye back and see where these strong returns that we've seen in the last little while in the mining sector have taken you. And you probably see that it probably takes you just back to levels that these businesses were at back in 2008. And if you look at that in contrast with these steady, can I call it more boring, compounders, that's the long-term perspective that we're looking for. Yes, from time to time, we will do our best to time these cycles correctly, because there's good money to be made in mining if you get it right. But we believe that over the long term, the big performance is really going to come from identifying those quality businesses that are investing their capital and delivering that magic, that eighth wonder of the world, being compound interest or compound growth.
Even my doctor was giving me a lecture about compound interest yesterday, which I was quite comforted by. Hopefully he listens to our webcast. I think also, these shares tend to be the ones that the foreigners buy into, because they're also looking to, when they take exposure to a territory, they want the critical mass players. They want companies that don't have to worry too much about. They know that there's a good management team and there's a business model where they don't have to be on the ground being close to the business. So, that's why you tend to see the likes of the Clicks and Mr. Price trading at pretty healthy multiples relative to the rest of the market. I think a very important slide is the makeup of the market. Now, a lot of us see indexes. This is quite busy, and I'm not going to drill right into the detail, but I put it in the slide. We're happy to circulate this presentation. It's a very interesting way to look at it. So we've broken the market, the SA market, and I refer to the Cap Swix because that's most people's benchmark, into the economic drivers, as opposed to a few kind of weird categories set by out of London, which aren't really that appropriate to the SA market. But the reality is you've got the banks are actually the biggest segment of our market, about 15%. Naspers and Prosus is now down to 12% through a combination of the restructuring and some underperformance. The miners are about 13%, and the diversified miners, PGMs are about 8%. So platinum is an interesting one. A few years ago, it was 1% of the market. It got up to about 10, and it's now sitting at 8. And telco is at about 7. So I guess one of the key points is that when you talk about the Cap Swix and the SA market, it isn't necessarily the SA economy. There's about 50% in SA incorporated, but again, within that, there's a lot of companies that aren't specifically South African driven. So, a fund manager has the luxury of choosing whether to have material exposure to the SA economy or not. One of the themes coming through here is that you've got much lower GDP growth than the rest of the world, but there will be times when you want exposure to that. And as we'll show you at the end, we've currently got about 20% exposure direct through into the SA economy as a driver. So we think this is the way we look at the market, as opposed to sectors, and it's really economic drivers. And then going through the stage on which we operate. So this is kind of the platform, and there's really 3 parts to that and 3 key things that we've got to keep an eye on. One is South African GDP growth. And we'll come to a slide a little later on that shows that global GDP growth sits at around 3.5% per annum, where SA is under the 2% mark. You can see that the rise from 2020 to 21, which is the recovery year. But then again, we think leveling off at around the kind of 1.5 to 2% if we're optimistic type level. So we've always got to bear this in mind. And we're never going to sit with a default of a company which is purely driven by the SA economy. The second thing that we've got to keep a very careful eye on, and a massive driver behind our market, is commodity markets. We could have put lots of different commodity prices here. We've chosen platinum because it's the most dramatic. And this is based to 100 at the beginning of this year. And if you go back 3 or 4 years ago, that was at 20. So that's gone up 400% over the course of the last few years, and is now down about 30% year to date, but still at kind of, the average levels of 2020. So the company is still generating a lot of cash. The third part of our equation is the currency, which I think if we got our currency called right 50% of the time, we'd be doing probably better than everybody else. But you've got a currency that's currently stronger than it was 5.5, 6 years ago. And this is our PPP model. If you guys deal with Anchor, we use this consistently for a number of years. And the market, so this is from 2000 at about 7 Rand per dollar, and using the inflation rate differential as the kind of PPP benchmark over time periods. And we land up with our Rand gauge. So we're currently saying the Rand fair value is probably around 14.50. So we're heading towards the right-hand side of fair and almost in cheap territory. Our current view is the Rand, the kind of risk on, risk off would tend to favor a stronger dollar, but we think structurally the dollar is likely to get weaker over a time period. So we're not in the camp at the moment of saying, expecting big blowouts out of the currency, but you have to take a measured view because the unexpected, as you've seen in this graph, can have big impacts on the currency. So, underlying the philosophy is always one of diversification of risks. Globally, you've seen GDP growth. If you saw the kind of 2% level we were talking about in South Africa, it's averaged about 3.5% until 2020, a big recovery year this year, but still thereafter sustained at very healthy growth rates. So, we've got to take all these factors into account in putting our portfolio together. A key graph that we've used quite a lot over the course of the last few months is, if you look at the red line, this is the S&P as an earnings per share number. So, 2 Rand on the S&P in this number times by 20p would give you an S&P level of 4,000, to put it in context. Now, back in 2019, that was 152 cents. It declined to 123 cents last year. And if you go back about a year ago, everybody was questioning whether market levels could get back to where they were, or earnings levels back to 2019. But all the stimulus that's been put into the market has seen market levels which are about 20% higher than 2019. So massive earnings growth coming through from companies. And that's what's driven the unexpected. I mean, we've been a bull on global markets for quite some time, certainly since the market decline in March last year. But I think it's exceeded almost every global investment bank's forecast, but driven by underlying earnings growth. And then drilling a little bit further into the commodities market, and this is something which would be an argument against the currency. We talked about platinum, and I mean, one of the most fascinating stories for me is rhodium. So rhodium is about 6 or 7% of the platinum basket. You can't mine for it specifically, but it's a byproduct. And the price of rhodium over the course of the last 3 or 4 years has gone from $1,000 to $30,000. It's now come back to about 15,000. But the world's entire supply of rhodium, which is predominantly South Africa, would fit into that truck. And that's why we put the picture there. So one truckload, it landed up being about 40 to 45% of the turnover of the platinum companies. And something that's really helped our trade balance and kept the currency strong over the course of the last year has been rhodium. So it's one truckload that saved South Africa's finances. Now, platinum's an interesting one. And Mike, maybe you want to talk through the chip thing. I mean, something we talk about so often, but to give you a term.
Sure. I mean, certainly, I think there's been an awful lot written about this in the press, and where it's really hit us in terms of sort of global, particularly the PGM world, is that production of vehicles has been hit severely by the chip shortage. And the complexity of it really is that, the increasing number of different chips that go into a motor vehicle today mean that, when you do get supply constraints around a particular type of chip, as we're seeing now, it can have a massive impact on the ability to actually deliver finished vehicles. And at the moment, as you can see there, we've seen the lead time on delivery of chips. But bear in mind, this is it's not a sort of homogeneous product. When you talk about it in the context of motor vehicles, it's the whole array of chips that are required in a vehicle.
The last thing I saw, you need about 15 chips in a standard motor vehicle, exactly. All different kinds.
And we're in this crazy situation where vehicles are being manufactured and stuck in vast car parks, but for the want of 1 or 2 chips, and thus unable to be turned out for sale. So this has obviously created a huge, essentially backlog in terms of vehicle manufacturing, which has flowed through to the PGM price, as we've seen over the last couple of months. I want to chat on this one.
Yeah, so I mean, the result of that is lost vehicle production, and vehicle production is what creates the demand for platinum. So that's what we're wrestling with at the moment. You'll see in our portfolio we do have platinum exposure, but there's no shortage of demand. There's a shortage of supply, and it's really a case of how long does that shortage of supply last. And as soon as the supply comes back, platinum demand comes back. So that's something, in terms of managing an SA equity portfolio, we're going to look at quite carefully. These are just some the most negative news in terms of suppressing platinum prices. And the whole focus is, and the key question in investment markets at the moment is, how long will this chip shortage last? And not surprisingly, you've got the platinum companies saying it'll all be sorted by the first quarter of next year, but many of the actual customers are saying second half or third quarter of next year. If we knew with certainty that the chip shortage would be alleviated by the end of the first quarter of next year, you'd be placing a massive bet on platinum. But there certainly is quite a bit of optionality given where the share prices are.
I might just make the point there, Pete, that certainly in terms of our positioning, we are to a fair degree holding the line on platinum, as much as it's proved to be quite a painful position.
It's marginally underweight, but still quite big.
Exactly. We certainly do see this being resolved, and there's very likely to be quite a surge in vehicle output to catch up with what we're dealing with at the moment. So as much as this is a tricky period we are navigating at the moment, it's certainly within the commodities complex an area that I think over the next 3 to 5 years we actually remain quite bullish about, certainly when one thinks of the broader green metals, environmental shift and all of those things that are going on, which are quite supportive for that sector in general.
Then our last kind of strategic view on local equities showed a 12-month range of a 20% to a minus 10% return in a bull and a bear case, with a projected return of about 15%. Now, I think year to date, we're sitting at between 10 and 15% for our equity portfolios, depending exactly which one you're looking at. And that's really, you've actually got more variability in global markets in terms of our projections. And that's because the rand does give something of a cushion. If global equity markets come off and that flows through into the SA equity market, typically the rand will weaken, giving you some protection in rand terms. So we think that with the new $100, we would expect a better return out of global investment. But certainly over the next 12 and possibly 24 months, we can find enough individual shares that we think you can get a pretty good return out of the SA market. I think then to flow through to and a segment of the market where, and it's as we said to you, banks is the biggest sector in the market. It's about 15%, so it's important. And you'll see what we say here, that banks in South Africa are pretty cheap, but it does provide you, it does give you exposure to that SA GDP growth story. And we think they're quite challenged over the course, if you take a 5-year view. And in fact, the bank results that have been coming through have been beyond expectations, but a lot of it is credit unwind. And if you look one level deeper, there isn't much fundamental growth coming through. So given its size in the market, we have to look at this very closely. And this is a very good indication in banks where they're cheap and we've got quite big financials exposure. But in fact, the only big bank that we've really got, well, Capitec, I guess, is now a big bank. We always think of it outside of the big four. Is in a range of kind of story-driven financial pictures, which aren't exposed to that.
I think, Peter, just to follow on from that, you're dead right. This is an excellent example of a sector where we're backing the high return businesses, the higher compounders, and then selecting a number of other financials which have specific stories attached to them, which we will get to. Broadly, I think if we were to sort of look at the rest of the banking sector, aside from being a proxy for GDP, I would almost see it as a GDP minus story, given that, increasingly this is a space that is challenged by the growth of the time banks, the telcos finally encroaching on them properly with their own mobile banking solutions. You've got the growth of the likes of Discovery Bank. So certainly when one looks at the traditional oligopoly of the big four, I think you've got to be extremely careful of assuming you can just buy and hold. You've got to be very careful of backing the decent management teams and those that are actually winning by delivering those higher returns. And that's exactly the way we're invested, as we will show you in due course.
And I think for somebody who's much more benchmark cognizant, you're going to find at least 3 of the big 5 in their portfolio in fairly big chunks. But we're happy to go outside of that. I think it's just interesting. I've just got a few charts on the different banks and their forward PE multiples. So banks are not high PE shares in South Africa. They've tended to trade on average at around a forward 9 times. This is Nedbank specifically. The average is probably closer to about 10. But we're sitting at about a forward 7 multiple. So when you hear, global markets are expensive. The US market is about 25% higher than its average. The forward PE multiple is well into the 20s. And SA, just by comparison, looks extremely cheap. And that's partly because of the composition of our market, where the mining shares are cheap on a forward PE basis, and so are the banks. And that gives you 45% of the market. But just looking at it in index level can be a little bit misleading. So that's Nedbank, a forward PE of 7. And what we're saying is we're not really sure that they deserve average PE multiples, given that average GDP growth is going to be quite dismal for the next few years once we've factored in a recovery.
And the question whether, this is I would argue, probably a relatively weaker franchise within, a slow growth economy is able to generate the returns it once could. So I would absolutely agree with you, unless it's not, we would tend to back quality within the space. And this would certainly not be one of them in our view.
Yeah. I think as you were saying, if you look at it in aggregate, mathematically, the banks can't grow a hell of a lot faster than nominal GDP growth because there isn't enough aggregate business for them to do. But within that, and we'll come to it, there's companies like Investec and Capitec, which we think fall outside of that paradigm and restriction. So Standard Bank, you're sitting at about a forward 9 PE multiple. So yes, that's cheap, but the average over the course of the last 10 years has been a forward 10. So, when shares have taken a whack and, they've got some recovery potential. But if we were to buy shares in a 5-year view, I think we would have very little exposure to the sector. ABSA's kind of in the same category as Nedbank. Interestingly, in the last set of results, ABSA actually surprised. They seem to have got their act together quite nicely. And then FirstRand, which is the best performer by a mile, certainly in terms of return on equity, what management's done with the business, their ability to grow in tough times. And this is the one that we own, right?
It is indeed. And just looking at the latest set of results, it was certainly in terms of genuine growth, excluding unwind from bad debts, one of the better ones. Pete did mention that ABSA eked out a little bit of growth, but certainly what we like is that FirstRand was in that camp as well and is likely to be the one that we believe, through essentially better positioning, better management, will continue. It's the highest return business. Yes, you are paying a bit of a premium for it, but that's the sort of quality that we tend to back rather than a sort of scattergun approach based on, cheap and cheerful.
Right. We'll then get to, I think in telling you how we view building an SA equity portfolio, probably the best example is the actual portfolio itself. And you can see we've broken down into different sectors. And I think one of the key themes coming through here, as we've said throughout the presentation, is you've got index level and index plays, but we've approached it slightly differently. And I think almost unintentionally, by a function of our philosophy and the way we look at companies and look at the opportunity set, only about 20% of the portfolio is the SA economy as the core driver. What do you want to add to it?
Yeah, as I say, I think rather than thinking about this as a first level of take the index, as a house, we're very much bottom-up focused. So we tend to identify companies we like, and the outcome is what it is. And as Pete mentioned, our exposure to the SA economy is low, and I would say even within that, if we were to say relative to the benchmark, our exposure to the SA consumer is even lower. Our sense is it had the sort of SA consumer story had a very nice recovery if you timed it correctly, out of the depths of COVID. But then if we look across many of the retail stocks, they've rebounded considerably. And we are quite concerned
to fair values.
The obvious opportunities there are quite limited now. And our default position when valuations are not screaming opportunities, back to our philosophy of high return, good management, we're going to take best in class. So hence we do have some exposure, but we're going to take it through Mr. Price, which we see as probably the best in class player within the consumer space. Within the bank space, again, as we discussed earlier on, yes, it's there. Perhaps valuations don't look that stretched, but frankly, given our fairly somber view on economic growth, we're going to play it through the quality component of the market. And then, outside of that, we're looking for very much company-specific opportunities. We think Investec, for example, is a much better value turnaround story, a self-help story. It was one of the ones we identified in an earlier slide as a special opportunity. And then, another factor that I think comes through quite strongly in this portfolio would be a very significant rand hedge component at the moment, be it through Bidcorp, be it through Richemont, be it through Quilter. Those are a few points that stand out for me.
I think also if you look at the property side, it's another indication of the philosophy and the approach where the property market, I think, is sitting at about 3 or 4% of the Cat Swix, depending on exactly how you measure it. But if you look at the average South African property company, they're really in a battle to grow their earnings. They've got cost bases, so there'll be a kick up when things recover. So something like a growth point when the V&A comes back, when tourists come back, I think it's running at kind of 60% of previous footfall. But once you get there, they've got leases escalating at 6%, but every time a lease is renewed, it's renewed at 20% less than what it was before. So once the recovery's happened, that's a flatline sector. Whereas internationally, we can find an Epi Rockcastle, which 7% euro yield growing at about 5 or 6%, that gives you 12, plus whatever rand weakness comes through over time. And mass, we just think is a very interesting investment opportunity. So then we get through to individual opportunities, which are kind of don't really fit into any particular category or theme. And I think where you want to be with a bottom-up investor. But it's maybe, Mike, you talk through the ones that you want to.
One that certainly, has been absolutely on fire in the last little while has been Thungela. And I have to confess that if one's to approach this with a very strict ESG hat on, or more the E side, it'd be very difficult to justify a position in Thungela. However, it's a very interesting situation, having recently been spun out of Anglo-American. Initially, I think a lot of funds just dumped the share. But what we've seen is as the world is recovering back to sort of normality in terms of power demand and these coal-fired power stations are being turned back on, the lack of investment that's been going into thermal coal has meant we've seen real tightness come through in thermal coal supply, which has obviously fed through into pricing. And for the time being, it looks like a very interesting opportunity. It's a share where on a free cash yield into next year, even after the run that it's had, is over 100%. So, a nice little opportunity. We're not going to be there forever. I do acknowledge that, all of these environmentally sensitive businesses, you're really swimming upstream. Sasol would be another example, I would think. But from time to time, these represent very interesting opportunities to make decent money. Afrimat, it's a position we're sticking with. I know that obviously its iron ore exposure is certainly counting against it at the moment. But within the smaller mining space, it's a business that I would see more as a miner. Pete mentioned earlier on that, there are a number of companies that are misclassified. This is actually classified as an industrial company in South Africa. I actually think it's more of a diversified miner today. A management team that has done a phenomenal job in taking what was a fairly boring quarrying business and making some very smart investments in various mining opportunities to put together a really interesting portfolio at great valuations and has really added value. And it's one that we are likely to stick with more because we back the management team to add value. Bidcorp is frankly one of our core holdings. Results out today. What I love about them is that you read through those results, they put a very simple, understandable message across, which is something that I always think is a tenet of strong management teams. They don't need to tie it up in jargon. We like it as a recovery play.
It's about 15% South African.
Yeah, as little as that. But a proper rand hedge, proper business offshore. Perhaps you can chat to Aspen, Pete.
Yeah, Aspen's a fascinating one. So it's a company that I've followed from 11 rand a share, but I think probably 20 years ago. It got really out of favor. They invested a lot of money being attracted by cheap debt offshore into some European businesses which were going backwards. They landed up at 50 rand a share probably 18 months ago after they published some numbers where their debt was up to 53 billion rand. They've got the debt down to a level where after the sale of a business they're looking to sell at the moment, it could actually be down to naught. But the really interesting story is the African Union the African Union has chosen J&J as the vaccine of choice, given that it's one dose and there's much lower temperature issues that they have to solve. But they've said there has to be South African manufacture for in order for them to back it. And Aspen is really the only viable party in SA, and they've been quite lucky in a way where they've created for their own purposes. They were creating a lot of sterile and vaccine capacity over the course of the last 3 years, obviously with no idea that the pandemic was coming this way. And what they're currently doing is manufacturing 220 million doses on an annualized basis for J&J, which they're selling on to J&J, and they're making about 15 or 20 rand a vaccine at the turnover level. A change in the nature of this contract, which I think the market is starting to price in and we expect to happen quite quickly, would result in them becoming the licensee, in which case they would make the full 150 to 200 rand per vaccine and they'd pay a royalty to J&J. So the commercial relationship changes, but it could result in anywhere between a 10 and a 30% rise in Aspen's earnings with no capex from their side. So that's suddenly become a really interesting story. We're happy to have been in it. I don't think anybody was expecting this, but it's one of the reasons you have to keep close to your companies and see exactly what's going on there. I think you then get to transaction capital, and that to me almost is similar to Afrimat in a way, where it's just great capital allocators. People who, when they're not paying the money out as a dividend, are going to use it in a fashion where they can earn a higher return that we think we're going to get in our equity fund. I mean, that's probably quite a good way of looking at it. One that, Mike, you think looks like good value and has got amazing cash flows is MultiChoice. Are they allocating capital properly? So guys, before I carry on to Mike, we're just going to talk to 2 or 3 more slides. Please pop your questions up in the Q&A if you have them. Otherwise, we'll carry on chatting. But just to prepare you before we end our kind of formal presentation. MultiChoice.
So Pete, it's a love it or hate it stock. And I think one that's often misunderstood by people in the investment community because they tend to look at it through the lens of their own world rather than appreciating what MultiChoice represents in Africa. And I was actually driving along the N14, towing my daughter's horse slowly to a show this weekend and driving past a squatter camp where I cast my eyes across the fairly squalid landscape and competing for the number of checkers packets blowing in the wind was the number of satellite dishes on those houses. And it just reminds me of the degree to which, MultiChoice is much more than, providing Springbok rugby transmission to high-end consumers in Sandton. And frankly, that's become a very big focus of its strategy, is really serving the mass market with content that's relevant to them. But as Pete said, a very strong cash generator. The South African business generates around 15 Rand a share. At the moment, a lot of that is being absorbed into a loss.
The share price, what is it today?
It's currently at about 113 Rand.
13. Okay.
So, at the moment, in essence, the loss-making business in Africa is being valued by the market at a negative value. And that is, despite the best efforts of Africa to devalue its currency as fast as possible, it would seem rapidly moving back towards break-even and profitability. Certainly the other big question mark, I guess, over it is whether, in terms of capital allocation, its recent investment into an online betting business is going to prove to be a smart move. And it's really the first move that kind of MultiChoice has made as an independently listed business since it was spun out of Naspers. So I think a few question marks over it, but don't underestimate how strong the cash generation is. And right now, we're also making the bet that this controversial tax claim that's been thrown at it by Nigeria is going to be resolved favorably. So, we're certainly in there for a number of reasons that we think the clouds will lift on MultiChoice.
Mike's always had the bad luck of any company that's got Nigerian exposure. He's landed up helping us cover. And certainly, I think back to MTN when there were terrible headlines and it looked like it was all over in Nigeria. People were talking about just leaving the keys behind. We stuck with that. I think back to kind of 40, 50 Rand a share. Today it's sitting at 140. And ultimately, you cannot put a high multiple on Nigerian earnings, but sanity does tend to prevail. And the courts have actually helped out the company somewhat. And then Quilter is one which I've always liked, and I think Mark's in the same camp. And this is in putting together an SA portfolio. Quilter, we think there's a great theme in the UK. Remember, this is the wealth management business in the UK that got unbundled from Old Mutual. And there's a great theme there in terms of pension fund reform, more and more people looking after their own pensions, needing advice. IFAs coming onto their platform. They're the second biggest platform business in the UK. And they're talking about, you've got market growth underneath, plus you've got this kind of thematic growth. And at the same time, they think with scale and a fairly fixed cost base, they can up their margin by 50 to 100 basis points every year. Now that equation gives you, I don't know, like 10 to 15% in pounds.
Exactly.
With a fair amount of predictability. I'd rather take that at a forward 13 PE multiple than 5% growth out of an SA bank at a 9 to 10 PE multiple. That's certainly our mindset. So let's I'm going to stop sharing the slides. Hopefully we've given you a nice picture of how we look at markets and how we compile portfolios. I'm just going to pop over to a few questions. Mark, for you, would financials, i.e. banks, be considered cyclical? Any reason not included in the previous slide?
Pete, yes, they are too, certainly when one thinks about it in a global context, yes, banks definitely sit, and I've seen it more and more in the way they're being classified recently in that cyclical category. I perhaps never used to think about them like that, but, I think what certainly the global financial crisis has made me realize, the way that regulators are now almost using the banks as a shock absorber every time we have a crisis. And I sort of wondered whether this is partly a consequence of a much more globally leveraged world. The thing that regulators learned in the global financial crisis is the first thing you do when we experience some financial stress is you go and stop the banks paying dividends. And I'm starting to see, we saw that again happen last year. And I'm starting to see, I'm thinking this is going to be a wash, rinse, repeat model. And I think that that's going to increase the cyclicality in the way banks perform as investments. So absolutely, I would see that as the status quo going forward. Yes, and even prior to that, I would argue if you thought about how they typically operate through interest rate cycles, they would tend to be cyclical. But I would say even more so today and going forward than they were in the past.
Yeah. Another question in the chat room, the view on REITs in South Africa, still too much downside risk. I think the property market is a little bit like the market as a whole. It is very specific companies with very different exposures and different outlooks. I think the average South African only property portfolio has got some recovery growth in it. As COVID comes down, more people return to shopping centres. And in fact, in the convenience sector, the convenience retail type sector, you've seen turnovers at higher levels in 2019. But once you've got to that recovery growth, the fact of the matter is that there's no ways that properties can sustain this kind of 6 to 7% escalation in an inflation environment of 4 to 5. And building costs haven't gone up for 5 or 6 years. So for the next few years, you're going to see every time a lease needs to get renewed, either there won't be a tenant, given the low economic growth, or there's going to be a 15 to 20% reversion. And we think that'll last for some time. So you've got 70% of your properties, the rentals going up at 7%, and 30% of them going down at 20%. And that kind of gives you close to a no growth scenario after taking into account the increase in cost base. So, that's the SA component, but within that, you've got some very interesting global counters. We really like Mass, and the CEO is a guy who basically founded and was resulted in the formation of Bepi Rockcastle, one of the smartest property guys we think in Central Eastern Europe. So that we think those look exciting. So in our SA equity portfolio, we've got Mass and Bepi Rockcastle. Mark, a question for you. quality CEOs leaving South Africa with the talent to replace? What does it mean for the future?
Yeah, I mean, there have been a number of instances where that's happened. Yeah, it is a concern. I suppose that we this is a great question, actually. I'm just thinking about that. There's a tendency, I suppose, to always want to focus on the horses we know. And, there's obviously a platform of people behind them that we don't know. And I suppose it's fear of the unknown that you doubt, the quality of the individuals. Yeah, but it's undoubtedly a theme that, has raised some concern. I think there were 3 kind of quite well-known CEOs that were announced recently that are heading out. I'm just thinking of the Click CEO as one that is heading on. My sense is one shouldn't overplay these things. It's never ideal to see this going on.
There's 100 material listed companies. We're talking about 3 people.
Exactly.
It's not a trend, but it is
Absolutely.
I think also, if you look at it positively, it's what foreign investors have always seen in South Africa is a high quality of South African CEOs. The fact that they're able to go and get those global positions. And in fact, Rob Schutte at MTN is a case in point. So I can't recall where he's going, but
he went to British Telecom. So he's now based in the UK working for British Telecom. Absolutely.
Yeah, I think there's many South African CEOs that can and will run big global businesses. And certainly from my days as a broker, when you took foreign asset managers around South Africa, they certainly rated South African management as among the highest quality in emerging markets.
And just a thought that's occurred to me, if you look at SA Inc. broadly in terms of how companies managed their way through the COVID crisis, and what was quite a patchy policy in terms of lockdowns and what have you, and certainly not merely the fiscal and monetary support that say US enjoyed. I would say South African companies in aggregate did a fantastic job of managing their way through the crisis. And, certainly the consumer retail orientated companies in particular, I can almost not think of an exception of a company that didn't materially exceed analysts' expectations ultimately coming out of this crisis. So I think it does speak sort of volumes to the fact that we still have pretty good tier of management in most of these businesses.
There's a question centering around more the US and the US market and economy, I guess. Will the US go into recession? Is it all about to collapse? We think quite to the contrary. There's a huge amount of momentum in the US, and companies are experiencing fantastic growth and some fantastic cash flows. And the technology businesses behind them have got incredibly strong tailwinds. So we certainly don't see much chance of a US recession. I think the short-term issue at the moment is more around a temporary factor of logistics shortages and the growth being so strong that it's actually put a constraint on everything. And we saw Nike's results come out yesterday, where they talked about, and it's really started in China, where their growth has slowed simply because, and it's similar to the chip shortage story, where they can't create enough product for the supply. So we're not really in the camp where we think the US is about to fall in a heap. And it's about that logistics issue. And then, are interest rates forced to rise faster than what people are expecting? Because is the inflation transitory type argument? But, it's more around those issues than any kind of collapse in the US.
I think that there's a fair argument that you can make that, maybe earnings expectations. Pete put up the slide earlier on, just showing how strong the expectations are currently around, the earnings in 2021 and 2022. And there's no doubt with the supply chain bottlenecks we're seeing, things that are almost beyond management's control. Is there a risk that we see pockets of earnings disappointment? Absolutely. I would be very surprised if earnings expectations haven't got a bit ahead of themselves and, reality catch up with us. But I think that's a long stretch away from a situation where we're talking recession and collapse. Certainly Pete dead right on the point that, technology and sector in particular has got some very powerful tailwinds. And
a lot of that's independent of economic growth.
Absolutely. And don't, in terms of secular trends, don't underestimate the deflationary forces that come through from, the advancement in technology. So, we certainly sit in the camp that, we're living through a fairly unpleasant period of intense inflation, but it is likely to be transitory. I mean, already, for example, you seem to be seeing commodity prices coming off, and very quickly that turns from an inflationary underpin to a deflationary force. So just a couple of thoughts there, not to become overly focused on some of those negatives.
Yeah, there's a question. We'll take two more questions, and I think we'll try and round it off. Dale can round it off in a few minutes' time. Will the resources sector recover from the recent slump, and how long before you get out of this cyclical? I think we're at a stage now. You had a rising tide, which benefited all resources. I think you're now getting to the stage where it becomes quite commodity specific, and I think there's very different outlooks for different commodities. Due to the energy crunch in the world, as we said, thermal coal prices have gone through the roof. So something like Thungela we really like. Iron ore's come off from $220 to $100. And the prices, I think the likes of the Anglos and Billitons never really priced in 220 at all. Otherwise, Anglos would have gone to 1,000. So you've seen them come off in the range of kind of 15, 20% or maybe 25% of their highs. But iron ore really becomes about China as a driver. And I think the property development balance sheet woes in China is the key reason they've come down. Platinum has got its own very specific nuances. There's been a temporary fallback in demand for platinum due to chip shortages. And there the question is really one of how long that lasts. Then you've got, the kind of new world renewables type metals like copper and lithium and the like, which, we think, there'll obviously be cycles within it, but they've got great 5-year futures. So, and I think you've seen that reflected in our portfolio. We've got very out of benchmark type exposure to resources based on the kind of arguments that we're using. I don't know if you're going to add.
Yeah, I mean, it's a great point you make there, Peter. I mean, one of the things we're facing as a bit of a challenge at the moment is I think that for a while, South Africa was quite lucky in that, the commodities that were performing, namely iron ore and the PGMs, were exactly the commodities to which our miners were most exposed. If we do talk about, maybe a move more towards green metals, copper and what have you, we're now looking at the likes of Glencore. It's probably a better way to play that. But, that has all sorts of ESG or more G issues that you have to make peace with. So, that certainly presents a much bigger challenge. Are you prepared to sort of hold your nose and live with those risks that, the regulators in the US dredge up some, act of disappointment that management committed in years gone past and in one of the countries it operates, because it represents really the only way to gain more pure exposure to, the metals that are now in favor. Unfortunately, Anglos and BHP very much more iron ore focused, which, has already fallen considerably. But, the immediate outlook, particularly with, as Pete mentioned, China looking to curb steel production related to property and its own environmental issues, is looking a little bit clouded, to be honest. The big question out there is the degree to which infrastructure spend in the US and Europe can offset what looks to be a bit of a headwind. So, me personally, I'm looking much harder at some of the other metals, and you'll see that within our portfolio, we are actually quite underweight the likes of Anglo and Billiton because of those concerns about iron ore for the time being. In short, I think it's more the green metals, the copper, the lithiums, the PGMs that are going to rebound. And I personally have a question mark over, what's going to push iron ore back up, particularly as potentially we see supply issues out of Australia and Brazil potentially alleviating some of the supply constraints that have actually supported iron ore in the past.
And I think oil will come back. There's ultimately an endless supply of oil. It's the extent to which they turn the taps on and off. And something like Thungela, which is the thermal coal story, I've got absolutely no doubt that thermal coal will come back to $60 to $80 at least from the current 160 over the course of the next few years. But that's not priced in. It's kind of it's trading at 1 year's cash flows. So maybe just to round off from our side, a lot of general questions coming through. Let's to pick one on China. That's going through a slowdown at the moment, quite a bit of it prompted by Chinese government actions where they've tightened emissions and trying to get climate under control. And then this Evergrande property development company where the balance sheet is a problem and they're not able to pay back their bonds, and that's raising a lot of concerns. So you are seeing China have a slowdown over the course, and you've seen that kick through into the resources companies that Mike's talking about, and iron ore in particular. My underlying feeling, and Mike can give it his perspective, is that the Chinese government has managed to manage GDP growth through the cycles and is the best placed in terms of capability to stimulate of all the countries in the world, because the powers that be can make the decisions in a very short time period without the political ramifications. So it's essential for China to keep their population happy, to keep that GDP growth coming. Everybody's waiting for that kind of stimulus to come through. I think they're not in a massive hurry, but I've no doubt that they will come through. Chinese valuations, I mean, particularly the Chinese tech sector, the regulations that they've got, that market's crashed. So you've got this huge valuation anomaly in the world where US shares are close to their record high valuations and Chinese shares are trading at less than 50% of those valuations. So certainly in our global portfolios, we're nibbling on the Chinese equation, although it does have its own idiosyncratic risks and we limit our exposure from a diversification point of view. But the underlying momentum, retail consumer growth, increase in GDP per capita over time, I think China will remain the biggest engine of world growth for many years to come.
Mm. Yeah, it's been a really frustrating year for us in terms of investing in China. And I guess if we could go back knowing what we know now, we might do things differently. But I would absolutely concur with the view that right now, it makes sense to hold the line. It feels to me like capitulating on China now would be akin to, selling global banks at the depths of the COVID crisis last year. And, then we've seen what's happened to the likes of JP Morgan rebounding to the extent it has. So, it does feel very oversold. I would say that I feel that going forward, China is going to require a lot more specialist investment expertise to do well. What I have learned through this crisis is that I think the importance of calling the right areas of China, as opposed to just sort of dumbly investing in the blue chips of that market, is going to become much more important, because from 5-year cycle to 5-year cycle, it's very likely that government policy is going to have much bigger influence in the relative winners and losers. And that certainly is the big learning that I've taken out. I mean, do I think that one should be holding the line on China? Yes. But the route out of this is likely to be probably a different grouping of shares to what one might have traditionally owned in the past.
And then you get some fascinating situations. I think a good example is Alibaba, where the government regulation saying you couldn't have walled gardens where you couldn't let other people in, and to get rid of anti-competitive practices. So Alibaba had to open up. And then you've got the third biggest player in the e-commerce space, JD.com, which then is now allowed access to more suppliers and can be a bigger business. So in fact, through all of this, you've had Alibaba get tanked 35% off already quite a low level, but JD Group going up. So I think you've got to understand what's happening there and be in the right stuff. So Dale, I think that's our story. I'll leave it to you to close up.
Pete, Mike, thank you so much for your time. It's always wonderful to see that if we go over time, if you've got two such fabulous storytellers, that we've got 90% of people happily to go over time to listen to you. So thank you very much. I think the interplay between both of you was wonderful. Just two very quick ones from me before we sign off. CPDs will follow as we get them. That normally takes about 10 days. And we do have an Anchor YouTube channel. So you can go back and look at all the recordings that we've made. Look at anchorcapital.youtube, and the recording of this session will be sent out to all people that have attended. Thank you very, very much, and we hope to see you at the next Essential session. Bye-bye.